And Kevin Flanagan now for more on the results of the 30-year auction. Kevin is fixed income strategist, Morgan Stanley Smith Barney there from Purchase, New York. Okay, so investors wanted more yield from the 30-year. What's your take on the results, Kevin?
We've been, sort of waiting for this to happen. It's been a surprise how well that we've seen supply get adjusted by the market. But I think to Brian's point, what you're finding out, the back end of the curve, this has been our concerns all along, that you are going to see investors, I think, demand more yield. This could be the first sign of what is to come in 2010.
The macro picture, are investors just losing confidence in the U.S., longer-term inflation, economic rebound, et cetera?
I don't know if they're losing confidence, but I think people are trying to find some alternatives. I mean, you had India buying gold last week, I think, as somewhat of a sign as well that, not that we're worried about another reserve currency or anything like that, but just looking for some alternatives. There's no doubt we've got fiscal problems here that need to be addressed. And in the meantime, I think you're going to see investors shy away or demand more to invest here in the U.S.
Yeah, Kevin, let me ask you, last month we saw the data come out where the domestic buyers, the money managers, did not want to buy the long bond auction. Do you think that's what's going on with this one, where the yield is spiking up because of the domestic money managers not wanting to own this long-term duration? And are you buying the 30-year?
Yeah, I mean, a couple of things. First, what we had been seeing up until late was money, believe it or not, moving into the longer end of the Treasury market. Managers looking for duration didn't want to go into corporates. Now we may start to see that trade reverse itself. No, I think the 30-year and the 10-year are still vulnerable here. I would not be buyers. I would still be a better seller.
Is there anything, Kevin, on the Treasury yield curve that you like right now?
I would stick in the 2 to 5 year area. To me, I think the Fed let us know last week with their dovish statement they're not in any hurry to raise rates anytime soon, which that in and of itself could be a negative for the back end in terms of inflation expectations. So I'd keep it low, keep my powder dry, and then wait for the eventual rise in rates and then come back and take advantage at that point in time.
So what is your forecast looking into next year? Where are the best bets in fixed income?
I mean, what we're focusing on our strategies is for that higher long-term rate environment. So, we've been focusing on instruments like floating rate notes, something that can mitigate against some of that interest rate risk. In the investment-grade corporate market, areas that are still, not back to where they were in terms of reverting to their mean and do perform in this environment. So paper forest products, metals and mining, and energy. I would be a seller. On the other side, like to be fair and balanced every once in a while. Consumer staples and, say, retail stores.
Kevin, you said you're holding back. Now, what levels are we talking about in terms of 475 in the 30-year? When does it get attractive? I mean, at 5% on the 30-year bond, I feel a lot of investors would be wanting to get in there at that level. But at what point is it really going to have to, compensate you for the inflation risk and the economic risk of holding the long-term bond?
That's a great question. I think the 5% threshold is going to be very important to see if, in fact, that does bring in buyers or we just blow through it. My concern would be, given the fact you have this huge amount of supply, the Fed is no longer a buyer, so we're losing 25% of the sponsorship there, that maybe at 5% you pause, but you're going through it. And I could make a case, I think 5.5 to 6 is where you're headed by the end of next year.
Our thanks to Kevin Flanagan, a fixed income strategist with Morgan Stanley Smith Barney, and Bloomberg's Brian Luke.